Hey YouTube, this is Zach with Achilles Financial. Today I want to talk to you about short-range air transportation, or more likely it's going to be air taxis from small, short-distance approaches. Think small airport to small airport or small city to larger city. The goal of this is to look at 3 SPACs, which are all looking to take advantage of the SPAC boom that is occurring in 2021 to raise money to see which one could make the most sense for your portfolio. The 3 companies that I'm going to be looking at include Experience Investment Corp, Atlas Crest Investment Corp, as well as Ascendant Digital that you see right here. So again, we're going to be looking at a number of companies today. So again, all 3 of these are going to be trading under different ticker symbols in the future. Right now, these 3 companies are looking at ACIC, which is going to be Archer Aircraft or Archer Aviation. We're also going to be looking at Blade Aviation, as well as looking at Wheels Up Aviation. And as you can see, some of these companies are even bouncing around after hours. All 3 of these companies are looking to go public via SPAC this calendar year, and we're going to be looking at all 3 companies utilizing their investor presentations that are provided on their respective company websites or under their SEC filings, where you'll be able to go and download that information the same way that I'm looking at it. The key things that we'll be looking at include revenue, profitability, and the percentage of the company that your shares or the shareholder is going to actually own. So I think that that's something that is incredibly important that is often overlooked. If you'd like to ask any questions or provide any feedback, feel free to use the comment section down below. Or if you want to go a little bit more in depth, feel free to join our Discord in the description down below. Lastly, if you would be so kind as to consider supporting me, feel free to like the video and subscribe. It would really help benefit the channel and help this video get out there. So, without further ado, let's dive into Archer Aviation. So, Archer Aviation, this is the company website. As you can see, the first ever commercially viable electric VTOL aircraft. And this is their aircraft that they're discussing. Again, think of it as a short flight for use for air taxi purposes. So the idea behind it is that you're going to have a very short flight from one location to another, all taking advantage of the very high performance electric batteries that are in place today. As you can see, this company is relatively new. In fact, they went public in May of 2020. So keep that in mind. We'll bring that up later. But as you can see, again, they have their aircraft today, and it has a 60-mile range using battery technology. And again, they're looking to use this to go about 60 miles per hour. So again, where you'll be able to find our information is by going to investors, and we'll be looking at the presentation right here. So here is the Archer investor deck. As you can see, all of these slides are going to have the disclaimer. They include future-looking statements. I am not an employee of any of these companies, and everything you see here is just my opinion. So keep that in mind. This is some guy on YouTube, not investment advice. So what we want to look at going forward is I am not going to be going through any of the technology behind these companies. So feel free to comment down below some of the greatness that these companies are providing. But I do want to discuss some of the financials behind the individual companies and what their expectations are. The reason why I want to focus on their expectations, not necessarily the reality behind those expectations, is because as someone who doesn't operate in the company, in the space, I don't want to add my opinion over that. However, I do understand the financials behind these transactions, so I do feel comfortable providing an example there and providing my opinion on those items. One thing that I want to continuously highlight here is that these are, again, going public via a SPAC, a special purpose acquisition company. What that means is that this company, which is currently trading under ACIC, in Q2, when the merger happens, is going to trade under ACHR. The company is expected to be valued at $2.7 billion. that is right now. I believe the expectation going forward is that this will be the updated valuation is 3.8 billion. And so they're looking to raise a lot of money with this, inclusive of 1.1 billion with $500 million cash and $600 million of PIPE proceeds. So see in the right-hand side of your screen, you see that PIPE proceeds. What the PIPE means is essentially these are investors who have the capability to purchase additional shares at any point in time over the next few months and use that money to be raised towards the transaction or just for the company to utilize that cash. So one of the things that we want to highlight is that this is a company that currently does not have any GAAP revenue. So they have bookings, which means that they have cemented some deals. You can see right here, 1 billion in orders from United Airlines and optional for additional 500 million of aircraft. One thing that we want to highlight though is that this is bookings. To get that revenue, they actually have to deliver on those orders. So keep that in mind because it's very important. The other thing I would highlight that's not included in this information is this company did start less than 1 year ago. So one of the reasons why that is important is because, as previously stated, currently being valued at $2.7 billion, started less than 1 year ago, and they have $0 in sales. Keep all of that in mind. So let's go actually talk about some of the company's capabilities. I'm going to continue to kind of scroll down through the screen just so that you have the capability to see essentially where this money is coming from. Again, they're saying that this is currently a $1.5 trillion total addressable market, or TAM. Keep that in mind as we look at two other companies in this space. So this is some of the people that they're hiring. This is some of their team right here. Again, all of the information that you see right here can be found and verified via LinkedIn. That's one of the things that I looked at prior to this. So their entire team is right at 60 people via LinkedIn. Because of that, it's super important to recognize some of these valuation numbers. So the way that they are making money is essentially they are going to be building these items for United Airlines. So this is going to be a little bit different than what we're going to talk about with their next two companies. But for this company, they are building the aircraft so that they can take people on these small range flights and air missions. Again, they would like to diversify. You see cargo and Department of Defense. I like that idea because, again, both of those are areas where you would expect the need here, especially for electric. Again, you can see the capability to go from a small airport to a small airport, or a small city to a small city, in these cases, larger cities. So again, ride sharing in comparison to helicopter, which I imagine would be much more expensive. You can see the cost to operate, and then you can see Uber, UberX, or personal vehicle. So this is something that's interesting. Again, I will allow others to kind of dive into the details here because we have a lot more to look at. I want to talk about some of the financials that the company is providing. Feel free to check out some of this other information because, again, they do provide quite a bit in here, and I think that that could be important. So one of the things that I want to talk about, though, as we're talking about the financial summary, is that this company is essentially raising $1 billion to use over the next 4 years. So if you are raising $1 billion, and if you as a user or a investor are providing them with that money, you want to know where it's going. As you can see, the goal is to build out and scale their organization. That makes sense, but it doesn't really clarify anything for me. What they're really trying to say here is they need to build a factory, they need to build the aircraft or at a mass-produced scale, they need to get it certified, they need to have passengers. There's a lot of testing, there are a lot of holes in the overall picture that need to be filled right now. So that's what they're going to be looking at using this for. One thing is they do have a very attractive long-term financial model. However, the key thing I want to highlight that is worrisome to me, and you can see that information here, is in 2024 is when this financial model starts. And at that point in time, 3 years from now, you can see that their free cash flow is negative $205 million. We'll zoom in just a little bit so that we can actually take a deeper dive in this. So that's what you're looking at here. The other item I want to highlight is their EBITDA, earnings before tax and depreciation. You can see is not positive until 2025. And that's somewhat concerning, especially when you see that the expectation for growth is north of 2,000% from 2024 to 2025. So my concern with what we see here on the screen is all of these numbers are very exciting and they seem too good to be true. And when something is too good to be true, it generally is. This is essentially taking $1 billion investment today and saying that you're going to get a 25% return on that investment in 2025 that's magically going to scale within the next 10 years to $4.5 billion. So again, just my opinion, although it does seem somewhat fanciful. I'm sure if I saw the investor presentation live, I would probably have a higher expectation here. However, they do include a lot of potential, but again, even that's not included in that forecast. So these are very lofty numbers that, again, cause some concern for worry. The other concern for worry that I have is their benchmarking that they're going against are the highest flying companies out there right now. You see Blade, we're going to talk about them. You see Uber, Lyft, Airbnb. I do not think that Archer is in the same shared space economy. I do not think that they are even in the same area as a Galactic or Virgin Galactic, QuantumScope, or EHang. Again, these companies are very different from what they're doing. You can see the 2022 number right here. This is 2026, 2027 for QuantumScope. So they're changing these years to make it look like what's best for Archer, and I fundamentally have a problem with that. You can see the same thing for the EV over EBITDA, and again, you also see some of the ridiculousness that is Tesla, but again, they're changing the numbers. If you're going to be doing a comparison for benchmarking purposes, benchmarking deliberately says that you are using it to see how your company measures up. You can see that they just don't, it doesn't make sense to me, and that overall is a concern. Again, what you're going to continuously notice for not just this company, but some of the other two as well, is I like the idea behind the company. I do not like the idea behind the valuation. As you can see here, the expectation here is the pro forma. So after this transaction, the expectation is that this is going to be a $3.8 billion company. Keep in mind, in January of last year, this was not a company, and they have 0 sales as of right now. Keep that in mind. Sales being revenue per GAAP, not just bookings. So we have a $3.8 billion company with less than 60 people working there, and they don't have any sales. Does that sound good to any of you who are investing? Again, if you are investing in this company, it is because you believe in the story, and I, for one, think there are a lot better stories out there right now that are actually profitable. As you can see, another concern I have is you can see the estimated transaction expenses, which go directly to the SPAC, is $63 million. So that means that this company is raising from the public $375 million. And out of that $375 million that they are raising, it's going to cost the company $63 million, or 17%. I feel like if I were to raise money, I could go to a bank and raise money better than 17% at an interest rate, even if it is a one-time expense. The reason they can't go to a bank is because I imagine the bank wouldn't back this, and so they're asking the people to do so. However, this is normal in today's market. My overall concern is what you see here. The public SPAC only owns 13% of the company, and the existing Archer shareholders, which again is going to be original investors as well as any ownership, plus the SPAC founder share, so not anyone else, plus PIPE. So if you're buying in, you only own 13%, and that in and of itself is worrisome to me. The good news is you can expect the merger to pass because all the shareholders are already owners and they want this to happen. The bad news is, again, you are paying a lot of money for something that you don't get a proper return on investment from. The person who's taking the 17% equity hit because of that investment that you see right here of the transaction expense is the 13% shareholders who are putting down the $375 million. So they're breaking it out by the overall value. That just means that whoever these founders are in there who own 3% of the overall company, there's two founders. So if you take a $3.8 billion company and you take 3% of that, those guys are doing pretty well for themselves since they both have $11.4 million now. So this is my big concern with the company is how they're treating the shareholders. This is one of the reasons there is a lawsuit out on shareholders' rights against them, where there's a lot of SPACs that have that going against them, so I don't know if anything will come from it, but this is just my concern. So with all of that being said, you may reevaluate your idea behind do you want to invest. Keep in mind that, again, these stocks, you can still make money off of them. I just think that if you're going to invest in a company like this, it can wait until 2023, 2024, where you can see if any progress has been made. If the company is trading at $5, $6 to $8, $10 billion at that point in time, that means that a lot of people have given money to it. My expectation for a company like this is you can't go 4 or another 3 years without any additional capital. So they're going to do another share raise after they do have a popular vehicle test or something along those lines where it does pump up the price. But this one's just not for me personally. So this is Archer Aviation. Now let's go on next to Wheels Up. So this is a little bit different of a company. This is called Wheels Up, and this is more, in my opinion, of a private jet, not necessarily a e-travel based or EV, although EV that can fly. So again, this is more so, hey, we want you to be able to take advantage of people's private jets. It truly is a different experience, but they're going public via a SPAC. So if you want to look at any of this information, you have the capability to go into the investor segment down here below. So investors, the presentation that we will be reviewing is right here underneath the investor presentation. So join us here shortly. So similar to Archer, I'm not necessarily going to go through the full company information, same sort of disclaimer. Just keep in mind that this is a very different company. However, there's one thing I want to highlight. There is a much, and this is just my opinion, there is a much more diverse group who is going to be managing this company as opposed to the other team. This group that you have here on the screen has a lot more experience from much larger companies. For that reason, I'm already a little bit on board. The other thing that I want to talk about as we go through here is, again, it is a different type of company. And a lot of that is driven by the fact, again, they're not going for those valuations that are strictly based off of EV speculation or renewable energy. The other thing is they have actual revenue. So this is something to be watching at. They've got a lot of really good partners, but they still tell a good story. And for that, I'm a little bit more of a fan for this type of company. You can see here that they're talking about democratized TAM, or again, total addressable market. The idea behind that is the airspace right now is incredibly controlled. Again, there's only a number of companies that are flying private jets. The idea behind this is that there may be opportunity outside of that. So there's a lot going on right now for people to be able to try and get into that space. You can see they're looking into the private aviation side. I do think that there is a market for it. So going to continue to scroll through here. Feel free to check out the company. Again, they've got a number of different aircraft you can fly. This is still smaller flights, not necessarily from Georgia to California, more so from city to city or even potentially airport to airport. Treat it like an app. So similar experience to what we were just looking at, although private jets as opposed to e-taxis. And this is a B2C company, not a B2B, which is what Archer, business to business. So again, they're growing active users, they are growing revenue, and they are looking for a higher contribution margin. So what we want to look at is, what does the business model look like going forward? You can see how they're planning on growing outside of their original membership group, which is one way to grow. Think again, recurring revenue, which is the big idea behind this. I think that this is going to be a very attractive way for business travel to occur in the future versus utilizing the much larger airplanes, is by, hey, we can take advantage of a smaller plane depending on the price. So that's one thing that'll be interesting to look at going forward. The other thing is, again, can they dominate the market? They do have somewhat of a first mover advantage. If they continue to take advantage of that, then there's a lot of money to be made there. So a lot going in terms of the overall business practice. You can see that the idea behind this is they are going to continue to add to the bottom line. These are big numbers and they can be meaningful. You can see some of the ways that they look to grow is, again, continuing some of that membership. But really, I think a lot of this is going to be associated with a return to business travel. I think that, again, they're well placed to be able to take advantage of some of that travel, albeit I don't think it's going to return as quickly as they may expect. What you can see here is the overall revenue continues to grow. Pretty significant year-over-year growth expectations of 21%, which is a big deal. And because of that, they expect to bring in nearly, again, you can see right here, 23,521 members. Huge increase. Let's look at the financial projections, because this is the one that we're really worried about. One thing right off the bat that I prefer compared to Archer Aviation, which we were just looking at, is they showcase a very high increase in terms of total cost of revenue, but they're showing money from 2018 to 2020. And again, they've got the actual numbers for 18 and 19 that actually show that there is money coming in. And while they are losing money, it's not bleeding. There's not a high level of cash burn right now. I think that this is genuinely a strategic buy-in that they can take advantage of. However, they are still not expecting to be profitable until 2023. You can see that $40 or $40 million that they're expecting here, and I think that is a solid number, albeit it could have a higher margin. However, again, there's a lot going on right now, and I think there's only upside for this company. They do tell a good story. So one of the things that is going to be important to differentiate is that, as you can see, even though I like the company story, I like the process a lot better, look at the SPAC shareholder expectations right here of 8.8%. So despite the fact that overall this is a lower price, 40 million compared to the one we were just looking at of 63 million, the overall expectation of what they're bringing in from the SPAC is much lower as well. And they're only getting 8.8%. So again, you're getting a company that's expected to be $2 billion, and then the shareholders are on the line for 200 million of that. So again, they're the ones paying that expense, and it's a little brutal to see such a low expectation. I didn't see a lawsuit out against this particular SPAC. Again, it's pretty common that these SPACs have lawsuits out there, so I wouldn't be surprised. I just didn't see one through a simple Google search. But this is something that we want to be looking at, is, do I want to be going in for a company that's going to currently retain most of the ownership? Again, I think that is good in the fact that owners will want the company to continue to be profitable and continue to do well. However, that generally means that there is some worry that you're not going to necessarily get as big a piece of the pie at the original entry point as you would expect. That being said, this one tells a very compelling story, and there's a lot of opportunity here. When you talk about some of the companies that they compare themselves to, I don't know if I would necessarily go into the e-commerce and subscription base. These all other companies just have very high valuations, which is why I think they're throwing their name up there. Again, investor presentations, you want them to look really good, but really we want to see, hey, what's the potential going forward? So what I want to look at is the comparison to Uber and Lyft, which you can see those companies have not been doing fantastic. And you can see, hey, is that something that we expect for them to do? From a revenue growth perspective, I think that they're beating an Uber and a Lyft, We just need to see if that continues and what the 2020 numbers expect that to look like. So as long as we see some of that margin expansion, then I think that they'll be okay. I am interested to see the capability going forward of, are they able to capitalize on this future value? You can see right now that they say the upside here potential is 46%. Keep in mind that's assuming that you get in essentially at that $10 discount rate or that $10 par value, which is what the SPAC's going public at. I don't necessarily see that happening the same way. Again, overall that they're expecting is 140%. We'll see. I would also say very positive numbers here. So this is just something to acknowledge. We can look at some of their financials. But again, what I'm going to harp back on, the 8.8%, so less than 10% of the company will go to the SPAC shareholders, which is what we have access to right now. And that is representative of a company that as of right now is bringing in less than 100 million in revenue, and they are not profitable. But they've been in business longer and they do actually have revenue. So another very interesting company. And now we're on to our last and final company. And this is Blade. And the reason we're going to be talking about Blade is because it is another short-term flight company that is going public via SPAC. Blade is an interesting company for me. They have a lot going on, like a lot of different places. One of the things that we're going to be looking at here is, again, you can go to investors in the top of your screen. This website doesn't necessarily show it as easily. Go to investors. We are looking at this presentation right here, which occurred in December. So just like the other two companies, this is a company that is looking to take passengers from small city to small city, large city to large city, and potentially the airport to airport. Again, they're looking to use helicopters or small planes. A lot of cool stuff associated with the company. So all the same stuff we've been talking about. You can see some of the different management here, not necessarily the same caliber, in my humble opinion, that we saw at Wheels Up. However, they do have a group with proven financial results. So that is something that I really like and want to see more of. Again, some of the things that you're looking to see as a result of the growth plan or of the money that's coming in is essentially additional market growth and additional builds associated with it and expanding that network. Some of the things that you'll see in a number of these presentations is, again, I'm not necessarily trying to review their business model, but rather I'm trying to showcase the financials behind it. As you can see right here, they're looking, or they are utilizing and bringing in money through a variety of ways. For them, most of it right now is coming in via this Northeast short distance, which is essentially in the New York area and kind of flying back and forth there. However, they do have other places that they are looking to expand into. You can see a lot of that expansion is outside of the Northeast to go from 10 scheduled routes to 28 scheduled routes. So this is a business looking to grow similar to how a Delta Airlines would grow through more routes and what have you. So not necessarily projecting obscene growth the same as the other two companies. You can see that you're still under $500 million in total revenue for 2024, but they are actually bringing in revenue in 2019, as well as I'm excited to see the 2020 numbers. So you can see that, again, they're expecting this to be, how can you decrease your commute time and essentially make it profitable for all the parties. So going to continue kind of scrolling down through here. Again, I'm not looking to review their business model or their reasoning for why they are essentially going to be able to grow so fast, but more so I just want to showcase, although I will show, hey, this is what you're talking about, helicopter to helicopter. And one thing I would highlight kind of as we talk about some of this information is that obviously the bulk of these companies are not necessarily looking to the average consumer for this information, but rather what they're looking to is wealthier individuals and people who are actively going to be utilizing and paying that premium phase. So some of the information that we'll look at here is the projected financial results that you see here. I really like how they break out their revenue as to how they're going to grow to these numbers. Again, this is not obscene growth, but it is larger. This is another company that I can definitely expect to see a capital raise. One thing that I would highlight is we are seeing some pretty substantial numbers in terms of the projected revenue growth. However, that doesn't necessarily correlate downwards to the profitability until 2024. All of these companies do expect to take some time to become profitable, and you can see that represented here on the slides, where again we're seeking high growth from their Northeast short distance, but also from some of these other markets, including their Blade airports. So they're not talking about some of these potential upsides, but if you truly thought it was an upside, would you, to me, wouldn't you want to include that? But again, all three of these companies have kind of had this slide of, hey, we have significant upside, but we don't know if we're going to be bringing that upwards. One thing that I do like is they do go through and say, this is where we are going to spend the money, and this is why. So that's important to me because as an investor, I want to know, why do you need my money? Why do you want my money? And why is it going to help the overall company? The other thing that I really like about this, and this is a slide that is probably not as good as the other two companies, but it showcases a key item that I personally am a big fan of, which is the SPAC shareholders in this scenario are going to own 33.3% of the company, and I think that is a huge deal for something like this. The other thing is, despite the fact that the company is looking to bring in, right at $275 million, which is more than Wheels Up, the transaction expense is only $25 million. And while that is still a lot of money, I, as an investor, feel better knowing that I'm going to own more of the company, despite the fact that we are losing a lot of that $25 million to bring that money in. I'm going to own more compared to some of the other stuff that we're going to be looking at. Again, this is not a billion-dollar company under the current expectation that you see right here, but I think it can grow to become one. There's a lot of upside associated with this company, and you as a shareholder get to take advantage of it. They do have some of that PIPE investment that can come in later as well, which will come in right at 15% of the total company. So there's a lot of ownership still involved, and for that reason, I think that there's a lot of value associated with investing in a company like that. So again, they're trying to compare to some of these other companies. I wouldn't necessarily place them in the recent EV mobility SPAC transactions because, again, those also have obscene valuations, and this one is not as surprising to me, although they are going to have a pretty high valuation. You can see from an EV to revenue perspective, I'm not on board with, again, using the 2024, 2025, although I'm not opposed to this particular company when I'm looking at it. One thing that I will look at is the profitability. They are looking to be much more profitable, and they are trading at some higher margins. They don't necessarily have themselves matching up to Tesla, Peloton, Uber, and Lyft. I don't even know if those companies are looking to be profitable during that point in time. So it's interesting that they decided to just say, hey, our average is 38.5. So again, a lot of the companies here, I wouldn't necessarily put them in the same group as, and I don't know if I would want to say that, hey, or this just kind of shows you how ridiculous. I think that Virgin Galactic now is actually trading at like 60 times the, what number would this be? I guess 2024, maybe 2025 revenue. Yeah, 24 profitability. So this is just some crazy stuff to me. But again, just a cool company, a lot of value here. And this is one that I could potentially see myself following up on after doing my due diligence. So keep in mind, just the last thing I want to highlight is, again, this company is going to own, or you would own 33% of the company if you invest in this particular SPAC, and they do expect to be profitable going forward. So keep that in mind. So keep in mind all the companies that we've looked at. We checked out Archer, we've checked Archer Aviation, we just looked at Blade, and the one before this we looked at Wheels Up. And depending on how much you own, I think is influential. And then you also have to recognize how long some of these companies have been in business and are they making any money, because execution is a lot more important than being a good storyteller. So this is just another video. We went much more in depth than we normally do. So if you made it this far, I appreciate you. Thanks for stopping by. If you found this content helpful, please leave a like and subscribe. And with that, I will talk to you later. Thanks.